Good morning, good afternoon, good evening, everybody. Greetings from New York City, where I'm working, meeting with our East Coast clients and fund providers. It's an honor to be introducing this very special presentation, where we're going to be dealing with some of the aspects of how we view things. You know, most people get their wealth manager to provide the investments and their tax person to calculate the taxes owing, and never the twain shall meet. The problem is that the twain do meet, and they meet in your pocketbook, because that's where the taxes are deducted from the returns produced by the wealth manager. Our approach is very different. Born out of a CPA firm, we always have an eye not only on wealth optimization, which of course is the primary goal, but also on tax minimization. And with that in mind, we're very pleased to present two very powerful IRS-compliant tax strategies. We brought an outside expert in, one of the lawyers with whom we've dealt for many years, Andrew Bernknopf, part of the DeCastro West and Chodorow law firm. Our firm has been associated with them for decades, and they're one of the resources that we use as needed to make sure that we have an objective seal of approval on anything we do or think about. Andrew is an accomplished attorney. He's a certified tax specialist and a seasoned expert in the field, one of those on whom we rely, and he's graciously agreed to do a brief presentation today in technical support of the matters we're going to be discussing. Jesse Picunko is one of our most senior advisors and one of the pillars on which RVW rests. He's a CFA, a Chartered Financial Analyst. That's the highest accreditation you can get in the field. And we think of it as a PhD in finance. He's one of our key people. He'll be presenting today along with Andrew. I just wanted to introduce them both, to thank you for your time and to welcome your questions and issues as you go through both of these strategies. As I said, IRS approved, very efficient, very effective, priced institutionally to give you the benefit of tax savings and tax elimination on the transition from concentrated equity positions, and some people have that, concentrated positions where you find out as a result of market activity that you're over-concentrated in a few stocks and you'd like to be more diversified, because as we know, concentrated holdings represent concentrated risk. We don't typically get into that position for our clients because our system automatically rebalances. But people either inherit, have stock positions from employment, or have legacy positions that they bought. And in situations where there is a concentration, then this strategy works extremely well where applicable. And then we're going to be working with Andrew Bernknopf to explain the inside workings of how a 1031 works, so that we can show you how, for those who are interested in liquidating real estate portfolios, and many of us in California are doing just that. This is a very powerful strategy to do that in a tax-free manner and diversify out of an underperforming real estate investment or a suboptimal apartment building situation in Los Angeles, for example, into a diversified institutional type, professionally managed portfolio where you become, as I tell my friends, you want to become a waiter. You wait for the checks to arrive from the institutions every month. And that is the role that I think some people want to be playing when the difficulties of management become too onerous. And this is a wonderful, wonderful situation where you can diversify out of single real estate concentrations and also out of California. With that having been said, it's my great pleasure to introduce you to Jesse Picunko, who will take you through the beginning of the presentation. Good morning, Jesse, and thank you.
Good morning, everyone, and thank you so much for joining us. I am very pleased and very happy to present the 351 and 1031 exchanges. I love seeing efficient opportunities that we can present to clients that help them save money and build robust, efficient, and limber portfolios that can best accommodate what their needs are. So let me get into these presentations. The first is on 351 exchanges. Now, this is a fairly new opportunity. It is a way of diversifying concentrated stock positions. As you know, you may have a great stock pick from 10 years ago that has done exceptionally well, or you have an inherited stock or equity compensation that has created concentrated positions for you. It's easy to get rid of them when they have not done well, but when they have done extremely well, it creates a tax problem. So the tax itself discourages you from diversifying and creating a better portfolio. Now, if you have a lot of companies like Apple, you're like, hey, what's the big deal? But if you have a company like Boeing or Enron, you might have been saying, hey, my gains are too big, I can't sell. And then you're left with a hit on your portfolio. So being able to diversify your concentrated positions is a very good idea. The 351 exchange is what allows ETFs, exchange traded funds, to replace positions inside their portfolio with new ones. All of our clients should have heard from us over and over again that we create very efficient equity portfolios at RVW because these ETFs are allowed to buy and sell without creating a taxable event for you. What's new is that we are able to seed a brand new ETF with positions from your portfolio. And the ETF manager, is allowed to trade those positions away and create a diversified portfolio for you. The shares you receive in this new ETF are kept at the cost basis of your original positions. In that way, when you make this transfer, you exchange your concentrated positions and you get new shares of this ETF. There are some constraints. You can't just contribute one position or one line item. The top position can only be 25% of the overall portfolio, and the top 5 positions cannot be more than 50% of the overall portfolio. So it requires a mix of securities, but the advantages are very, very profound. So when you're able to do the 351 exchange, you get an instant diversification. It is not a taxable event. There is no lockup like some exchange funds. This is not an exchange fund. It's a 351 exchange. And it's traditional 1099 reporting, not K1s. So this is a great opportunity for clients who have those concentrated positions and are looking to reduce their risk. Specifically, new ETFs do not launch every day. And when they do, they have to be set up to accept these new shares. The next one coming up, or the next opportunity to come up, is with Avantis. We have worked with Avantis for many years, and we have high confidence in their funds. This new fund that's coming out is a actively managed, enhanced U.S. equity portfolio with an emphasis on smaller cap companies, higher profitability, and a value-oriented approach. It is based on the Nobel Prize winning research of Eugene Fama, Ken French, and decades of factor research based on these ideas. So it's not fly-by-night, very established, historically successful strategies. And as I said, when you exchange your highly concentrated and appreciated positions, you will get shares in this ETF upon its launch. Next thing to discuss are the 1031 exchanges. Many people know about 1031s, that they allow you to replace appreciated real estate and get into a new opportunity. That's the very simple approach. With the RVW approach, we are investing in broadly diversified real estate positions that solve a lot of problems. First, their costs are lower. You get institutional pricing for insurance, maintenance, and mortgage costs. You have much more liquidity after the REIT conversion. You have geographic diversification, and you have property type diversification. So this replaces your concentrated single property real estate with a broad portfolio of assets. Now I'm going to hand it over to Andrew to elaborate on the process for moving from your single property to diversified ETF.
Okay. Are we talking about? I wasn't expecting to be addressing Section 351 exchanges, but I will a little bit. The two topics for today we're referring to by numbers. Those numbers correspond to sections of the Internal Revenue Code. What Jesse was talking about were so-called 351 exchanges. Both strategies that we're going to be addressing, first 351 exchanges, and then what I will address further, Section 1031 exchanges. They're paired topics for discussion because they are both tax deferral strategies. They are a means of moving from one asset to another qualifying asset without triggering tax, meaning, to use a technical term, recognition of gain in doing so. And as Jesse pointed out, they in order to preserve that gain for later taxation, you end up with what's called a carryover basis in the new position, meaning if you bought stock for very low price someday, as you move into a 351 fund, you maintain that low basis in your shares in the 351 fund, but you have moved from a concentrated position, which involves particular economic risks, to a diversified position without triggering a tax. Also, keep in mind that if one were to hold on to this position until date of death, then that income tax basis, which was low, would be reset to fair market value at the date of death. So this is a useful way of going from a risky, concentrated position to a diversified position. If you do sell the 351 fund, or as we're going to discuss, what you exchange into under a 1031 exchange, if you do sell that during lifetime, then you recognize your gain and you pay your tax at that time at which you receive cash from cash proceeds from the sale. So these are deferral strategies, unless you hold until death, in which case your estate escapes the tax. The mechanism for 351 exchange is for a group of transferors to a corporation to collectively control more than 80% of the shares of that corporation. And details that Jesse had referred to regarding that transfer, in order not to trigger tax on that, those transfers require that certain rules relating to diversification, as set forth under the Internal Revenue Code and regulations, are not violated. And those are referred to as the 2550 rules. No single position of a transferor, or perhaps this is viewed as the group of transferors, exceeds 25% of the value of things that are contributed, and no more than five or more positions in any particular issuer can't exceed 50% of what goes in. The point being that with regard to these funds, I would expect that they would have legal opinions, which are no guarantee of the tax treatment, but would definitely show that there had been thought by experts about how the tax treatment would be accorded, that these rules under Section 351 of the Internal Revenue Code are satisfied. So definitely make sure in reviewing offering materials that there is some discussion about the application of Section 351 to what you're doing, so that you are comfortable that you would not be recognizing any a taxable event upon diversifying. I'm now going to move on to the next topic, which is Section 1031 exchanges. Again, very comparable to Section 351. Both of these provisions of the tax code say that you can do certain exchanges of property for other property without having a taxable event. In the case of Section 1031, it used to apply to various types of property, including certain types of personal property. That had been narrowed, I believe, in 2017 to only cover now an exchange of real property for other real property. And that is known colloquially, sometimes instead of a 1031 exchange, you may hear this described as a like-kind exchange. In order to qualify, you have to have an interest in real property that you are exchanging. And it can't be an indirect interest in real property. It can't be a partnership interest in a partnership that owns real property. It has to be a direct interest in real property. And furthermore, it has to be an investment or business real property. It can't be personal use property. It can't be a house that you're living in. So when you exchange real property for other real property in order to perhaps diversify or perhaps to move on to another real estate investment that you think has better prospects, you can't receive the cash. If you do, that blows the exchange. So you have to hire somebody, all in accordance with tax rules, generally referred to as a qualified intermediary. You have to pay them a fee in order, when you're selling your property, to hold those proceeds. And there are very strict rules about timing as to acquiring what's referred to as replacement property for your relinquished property within 45 days of closing on this sale. Again, you're not touching the proceeds. They're held by an accommodator or qualified intermediary, sometimes known as QI. Within 45 days, you have to identify possible replacement properties and have to do so in writing. And then within 180 days of closing on your sale, you have to you have to close on the acquisition of replacement property, all done via your accommodator. And there are certain things that might have to be done in anticipation of all of this. If you happen to own an interest in a partnership and your other partners don't want to do a 1031 exchange when they're ready to sell the property, they might have to you might have to make arrangements to distribute out a direct ownership interest corresponding to your share of the partnership, a direct ownership in a piece of the property, that's referred to as a tenancy in common interest or a TIC. I'm going to use that term again. So there's a market for replacement properties that may be other wholly owned property that's out there, or other TIC interests that people are selling, or something that's newer on the horizon, which I'm going to discuss further, which is an interest in a Delaware statutory trust. What is that? We'll get to it, and that's sometimes referred to as a DST. Just one point before we get there: in order to qualify for complete deferral of tax under Section 1031, you have to reinvest the entire proceeds of sale. And that also involves reinvesting a certain amount in order to correspond to whatever liabilities, mortgage or otherwise, that might be on the property that you're selling, and have that correspond either in terms of a new cash investment by you or a new amount of debt in the replacement property, in order to not recognize any portion of your gain on this exchange. If you receive some portion in cash or other debt relief or other property that doesn't qualify as being like kind with the sold real estate, that's called boot, and that portion gives rise to tax. Now, the new topic, the new twist on things that I'm here to talk about are interests in something referred to as Delaware statutory trusts. The main idea is that those are a creation of Delaware law, which allows the organizers of these, you might call it funds, they're comparable to funds, to cause the investors' interest in those funds to be treated as TIC interests. In other words, items of real property that are eligible to be received under a Section 1031 exchange. The key to that treatment is, under Delaware law, a trust can be organized. It can function essentially as a business, very comparable to a professionally managed LLC that a syndicated LLC interest that holds real property interests. But it is treated for tax purposes as the investors are treated as having an interest in what is called a grantor trust. A grantor trust is disregarded as a legal entity for tax purposes, and it means that each investor's investment in this DST is treated as investment in real property. That is the key to making this eligible for treatment under Section 1031, resulting in the ability to go from whatever holdings you have in real property to something else, and something else being something that is an institutional investment, even possibly if you were to go from one single investment in a parcel of real property, wherever that may be, to possibly, subject to all these timing rules, diversifying. That's our theme here, possibly diversifying into more than one interest in a DST, or some other interest in a TIC, or some other piece of real property. All of that, and it's a little bit trickier than some other provisions of tax law. Again, all subject to these timing rules, identifying replacement property within 45 days of your sale and closing on it within 180 days. And also in terms of matching up your proceeds of your sale with what you're investing in. But the nice thing about DSTs is that there would be some flexibility as to what portion of that DST offering you would take that accommodates your need to have a certain amount reinvested. So this can be a very attractive opportunity under Section 1031. Next slide, please. It's really the key to it is that you're obtaining something akin to a partnership interest or something that is a part of an LLC, but doing so in a way that's eligible for a 1031 exchange. This goes back to the tax rule that only real property for real property is eligible for a 1031 exchange. And you can't exchange a partnership interest for another partnership interest, even though that partnership may own nothing but real property, and you can't exchange your real property for a partnership interest or stock or anything else. One further note, there are secondary markets for these things. I don't know how active they are, how real an opportunity to exchange out is, but since you own real property for tax purposes through your interest in a DST, if you're not satisfied with that and subject to whatever transfer restrictions the promoter, the trust has, and subject to market conditions, you can exchange in to a DST and you can exchange out of a DST. Most likely, the exchange out of the DST is when that particular investment, as managed by the trustee of the DST, decides it's time to exit and is going to sell. At that point, you're selling a piece of the property, and so you can exchange into something else, some other DST that's just starting up, some other piece of real property. And again, if you happen to pass away while holding your DST interest, that low basis that you have in that interest gets stepped up for the benefit of your heirs, your beneficiaries. That gets stepped up to fair market value. Just one more slide. Keep in mind that in order to qualify as a grantor trust and to obtain this treatment as real property for tax purposes, there are strictures on what the trustee can do. So it's not exactly the same as buying into a interest in a syndicated and professionally managed real estate project. You cannot make additional capital contributions. The investors can't do so. There can't be distributions of refinancing proceeds that sometimes you'll find if you're involved in a partnership investment. And so it's generally suitable for what those in the industry might call mature properties that are fully developed. There will probably be some sort of timeline or cycle, as it's referred to, for this DST to last. Other provisions of tax law will apply, including if this investment were to throw off losses, would probably almost certainly be subject to passive loss limitations. On the other hand, if it's profitable, it would produce passive income that could absorb passive losses from other investors. As with 351 funds, I would expect the organizers to have an opinion on the tax treatment. But all in all, it's DSTs are an attractive opportunity there for those who are considering getting out of a particular real estate investment and getting into a professionally managed institutional type investment, all without triggering tax on that exchange. And for that reason, the two topics today are very well paired. And just one more slide that's closing remarks. Anyway, there's some contact information about my firm, and I thank you for listening to my part of things.
Hi there. The DST is an intermediary step before we get into a larger, broadly diversified REIT. And so it's an important step. It needs to be done, and it's very confusing for some of the investors. That's why I wanted to go through it. But our goal is to have a very diversified end game that allows for more liquidity and more different property types and geographical diversification. I want to bring Selwyn back on for some closing remarks.
Thank you very much, Jesse. Thanks, gentlemen, for your input. Jesse, I'm going to invite you at the end to show off some of the wares, if you will, and end with that, with the pictures of the properties that we've invested in. And I say we because my own families have been doing this progressively, selling off California real estate and going into these through the DST into these broadly diversified institutional portfolios without triggering any tax, and getting, as you've heard, professional management. So just to recap on the real estate, what you've heard from Andrew is a detailed technical analysis. Be assured that all of that is handled by our due diligence team. We're making sure that we're dealing with credible, huge institutions, that all of the legal and tax work is completely 100% compliant and approved by their internal lawyers and tax people. We don't see that as a risk of any kind, given the stature of the firms with which we are dealing, and the quality of the properties speak for themselves, as you will see. So just to wrap up, two powerful strategies bringing added value to our clients and those who are not yet clients of ours, so that you know that we're always out there looking for the best ways to optimize your long-term financial well-being with optimization of income, minimization of tax. The 351 is there to diversify concentrated positions into a broadly diversified, institutionally managed, low-cost, tax-efficient ETF. And the real estate is there to take you out of concentrated positions and, if necessary, out of California and into a really beautiful, high-grade, institutional quality, no garbage, no rehabs, no upgrades. The funds we're in buy outstanding, beautiful pieces of property. This is the space that used to be occupied by institutions. But these and used to be the place where very wealthy families and pension plans and insurance companies used to invest. These funds have now opened up to select investors. We're part of the group. So, and of course, being our clients are coming through us, you have access to all of these. And by the way, unlike others who will put you into various different classes of investments, whenever you come into any of these investments with us, you come in through what's called I class. That stands for institutional. No kickbacks, commissions, incentives, incentives, prizes, trails, awards, rewards. There's a saying that I made up a long time ago, which should appear in the biblical journal for finance, but it doesn't. And it says, what the big print giveth, the small print taketh away. Some of you already know what I'm talking about because you've been with others. We have no small print. You don't need a magnifying glass. We don't make any commissions, trails, or incentives. Every fund which we put you into, and both of these categories enable us to put you into superior funds. They come in different classes. We never get a commission, never get a kickback, never get an incentive. We work only for our clients. That's the highest level of integrity you can have in our business. It's called being a true fiduciary, and that's the space in which we live. With that, I will hand over to Jesse to show you some of the pictures, because a picture tells 1,000 words. Jesse, I think you've got them on your deck, and I'd love to show off where my family is now invested, and where all of you are invited to do the same.
So as I said, there's a lot of different property types in these funds, specifically industrial properties or apartment buildings or data centers, student housing. But it's always very top tier properties, never dilapidated, slumlord type situations, very nice, pristine conditions. So here are some examples of the industrial properties. Here are some of the apartments. And here is what the data centers look like. Very institutional, very professional, and really forward-looking, very thematically, thoughtfully invested. So we're very happy to present these opportunities. Please reach out to me or Selwyn or Kelly or Jonathan for any questions. We'd be very happy to go through these processes with you and help your portfolio grow. Thank you so much for joining us this morning. We're very excited to present this and excited to hear from you in the future. Have a great day.